Hi, this is Dave Berkowitz. I want to talk to you about one of our remarkable companies, Markel, the insurance company. Just to give you an example, my brother-in-law, who's been staying with us for a couple of months now because my sister-in-law is sick, he asked me the other day why the insurance companies are going up, or why this insurance company, the one at Markel I was telling him about, why the stock price was going up when they have humongous catastrophic losses. And so here's the headline that I got. Markel incurs huge catastrophe losses. The number exceeded $500 million of losses, and they were still counting them. And that resulted in a diluted net loss per share of $18.82. So the question becomes, why is this? So I figured I'd just talk a little bit about why, and then I'd let Markel's co-CEOs explain why they had a great quarter and they also fulfilled their mission of being able to pay out and help rebuild the lives of their insureds. You can see here, this is Markel's stock chart on Bloomberg, and here's the earnings 2 days ago. So you would have thought that the company's stock would go down, but in fact it went up, and let's get on with it and I'll explain why. But first, let me just remind everybody, Markel is our biggest position in the hedge fund, and it's the oldest position. In fact, the partners that contributed tax-free Markel to our hedge fund at the beginning of the Value Line Fund actually contributed lots that go back to the early 90s. Markel was first public in 1986. That was December of 1986. So its first full year as a public company was in 1987. And just so you can see, the last 5 years, that's since 2012, Markel has returned 18% per year. I want to remind everybody, Markel does not pay a dividend, and that's an 18% total return for 5 years since 2012. And then you can see here, this goes all the way back to 1987, and it's been it returned 17% per year since its IPO back in 1986 at $10. It's now at $1,088. That is a huge, huge total return, and it's almost very similar to Berkshire Hathaway, Warren Buffett's Berkshire Hathaway, and many, many investors call Markel the baby Berkshire. For good reason, I think, too. So enjoy. You're going to listen to the co-CEOs. The first one you're going to hear is Tom Gayner, who is the co-CEO, and it was his job on this call to introduce the quarter. And then you're going to hear Richie Whitt, who is the other co-CEO. You're going to hear about the insurance operations, but most specifically, you're going to hear that pricing is firming finally, and is one of the great reasons that when you have these major catastrophes, insurance companies first usually take a hit, but then when people recognize that the premiums are going to go up, then the stocks start to realize that future looks a lot brighter than the immediate past. That's the insurance operations that Richie Whitt's going to talk about. And then Gayner's going to come back and tell us about the investment operations that he has, both the investment operations in bonds and stocks, but also the investment operations in something they call Markel Ventures, which is their industrial segment where they go out and buy companies in total, very similar to what Berkshire Hathaway does. And you can hear how great that division did and contributed to their cash flow this quarter. So without further ado, here they go. Thanks. Talk to you soon. Bye.
Mark Twain once said, "A man who carries the cat by the tail learns something he can learn no other way." I don't know if Twain was anticipating the record catastrophe losses of 2017 when he penned those words, but as a fan of his, I'm going to give him credit and foresight and brilliance with this bit of wisdom. 2017 will be a record year for catastrophes. And at the moment, we've got 66 days to go before the ball drops in Times Square to call time. Catastrophes are known as cats in the property and casualty insurance industry, and it is our job to pick them up by the tail. That is what we do. In doing so, we fulfill our social responsibility and our reason for being by responding to the cats with resources to help our policyholders put their lives back together again. As we reported, we will record charges of just over $500 million net of our reinsurance recoveries to pay claims to our policyholders for losses they suffered as a result of Hurricanes Harvey, Irma, and Maria. Additionally, we've witnessed earthquakes in Mexico and fires in California into the fourth quarter. As I said a minute ago, 2017 is not over yet. The good news is that our policyholders can count on us to help them in their time of need. Times like these demonstrate why they bought insurance. Times like these also speak to why we manage Markel in a conservative and prudent way. We do so in order to have the ability to respond quickly and appropriately to help our policyholders get back on their feet. We keep our promises. As Twain alluded, we also learn something as we pick up these cats by the tail. Specifically, the underwriting of insurance involves gathering data and making informed judgments about the probable costs of bearing the uncertainty of future losses. In each and every event, we learn more by gathering new and expensive data, and future predictions become based on more robust data, experience, and judgment. Just as we have in the past, through previous record catastrophe events like the World Trade Center attack, Katrina, Rita, Wilma, and others, we will learn, adapt, and proceed with more knowledge as we go forward. Finally, I want to remind you as fellow shareholders that we as a company are reporting positive comprehensive income to you this morning. We've designed Markel to be a resilient and durable company that our customers, shareholders, and associates can depend upon. In addition, and I do mean in addition to the $500 million of catastrophe-related payments we are making to our policyholders, we earned pre-tax net investment income and dividends and interest payments of roughly $300 million. We also earned pre-tax unrealized gains on our investment portfolio of over $800 million. We produced EBITDA of $115 million at Markel Ventures so far this year, and if you total up these items, there are positive returns from two of our three engines that total well over $1 billion of pre-tax ins compared to the $500 million of pre-tax outs. I also specifically use the words pre-tax since there are elements of tax efficiency in these numbers that also improve our net financial circumstances. I am proud of our organization that we can create the win-win situation of providing $500 million of support and payments to our policyholders and increase the net worth of the Markel Corporation at the same time. That is the design of Markel, and it is win-win. It is easy to say and hard to do.
I'll make a couple comments about the market. It feels like for the last several quarters I've been saying the market remains competitive and not much new to report. Coming out of the third quarter, I have some new things to say. The property market is clearly in transition. By that I mean post the events of the third quarter, there's clearly momentum building for rate increases. Questions that remain are how much will rates increase and how broad-based will rate increases be. Our sense is the extent of rate increases will play out over the next several months all the way into next year. As the actual losses from these events are realized by companies and as we get closer to the critically important January 1 renewals, the breadth and depth of rate increases in the property market and beyond will emerge. At Markel, we are seeking rate increases on all property business. However, we're not taking a one-size-fits-all approach. On loss-free or better-rated accounts, the necessary increases will be smaller. On loss-impacted or relatively more aggressively rated accounts, we'll need larger increases. We also believe that rate increases are needed more broadly than just property business. We believe there is very little, if any, margin left in casualty business, and that rate increases are required in casualty lines as well. The spillover effect of increasing property rates into other lines of business could take longer than finding the new, higher market level for property rates, but we do believe this is going to occur. We will be actively seeking appropriate rate increases across all of our casualty lines. A longtime industry veteran recently said to me, "Talk doesn't move market pricing. Earnings and capital destruction moves market pricing." It is clear that these events represent meaningful earnings and capital destruction to the industry, and the only logical response will be for companies to raise prices to more adequate levels.
Enjoys a relatively unique position in that we have three powerful engines to drive this company forward. Richie described our insurance engine circumstances, and I'll pick up with our investment and industrial products and services engines. The investment engine produced excellent results during the first 9 months of 2017. We earned 17.6% on our equity investments through September 30th. More importantly, our longer-term record remains one of the finest in the investment industry. We've outperformed the S&P 500 index by more than 100 basis points over decades, and this record continues in 2017. We do so at extraordinarily low costs and with a high degree of tax efficiency. Currently, we have roughly 64% of our equity capital invested in publicly traded equity securities. This is enough to give us a meaningful return in pleasant environments like what we've experienced so far this year. It is also balanced and conservative enough to provide a measure of safety and liquidity to absorb bad news and remain in a position to make positive investments in more turbulent times. In our fixed income operations, we continue to execute our strategy of owning high-quality, plain vanilla bonds and matching the duration of our portfolio to that of our insurance liabilities. We earned 2.8% on our fixed income holdings through September 30th, and we continue to earn the coupon. There were no credit losses to report, as has been the case for quite some time. That is how it should be. I'm delighted to report to you that is also how it actually is. Our industrial products and services engine, known as Markel Ventures, also produced substantial positive results. We earned EBITDA of $115 million versus $133 million in the prior year. When you look at those raw numbers, I would suggest that you also look at a couple of additional items. One, we recognized a $20 million loss due to storm losses on inventory from Hurricane Irma. That number represents the cost of inventory that was damaged by the storm. As we point out in the 10-Q, we recognized nothing for future insurance recoveries from that loss. Let me assure you, as fellow shareholders, that we were insured for that loss, and we do expect meaningful recoveries in the future. The two fundamental principles of accounting are conservatism and matching. In the fundamental covenant of what accounting is meant to do, those principles mean that whenever there is a choice about how to present financial outcomes, you're supposed to present things in a more conservative rather than aggressive way. You're also supposed to match revenues and expenses in the periods in which they occur. I would suggest to you that this $20 million of expense is about as conservative as it could possibly get. I would also suggest to you that I, as a former accountant, struggle to understand how this third quarter expense comports with the fundamental principle of matching revenues and expenses in the same time period. When you go from the covenant of accounting principles to the contractual process of GAAP accounting, rulemakers necessarily delve into definitions, processes, terms, and procedures that are necessary to create actual journal entries. I'm told by our GAAP accountants that the expense of the inventory losses are certain and knowable as of the end of the third quarter. I'm also told that the insurance recoveries are not knowable enough or precise enough to do the other half of the journal entry where we would record a receivable on our books in anticipation of the future claim that we expect to collect. What all this means is that in the not too distant future, we should collect insurance proceeds from this loss, and at that time, we will record the entire amount as income in that period with no associated expense. Secondly, we recognize $10 million of expense in the period for paying out an incentive earnout from a previous acquisition. I remind you that paying an earnout greater than what we expected means that things have gone even better than we originally anticipated. Let me say it plainly.